This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hi, I'm Dan Coatsworth. Welcome to the AJ Bell Money and Markets podcast. And it's a slightly strange start to this week's episode. We'd actually recorded a full episode, edited it. It was all ready to go. And then we had the breaking news that Donald Trump had decided to pause the tariffs on certain countries, and markets rallied hard. So I thought it was worth recording just a little bit extra to go at the start, just to put things in context and to show that we aren't completely oblivious to this very fast moving world that we're in at the moment. Now, we're going to go into lots of detail on the podcast about why we saw big movements up and down on the stock market over the last week later in this episode. But I think the extra bit to just address is that Donald Trump now says he's going to pause tariffs on non-retaliating countries for 90 days. It's not that clear cut. He's actually setting a baseline tariff of 10% on all imports, which will remain in place. And at the same time, increased tariffs on goods from China to 125%, accusing Beijing of a lack of respect after it retaliated, saying it would impose tariffs of 84% on US imports. So now I'm recording this on Thursday morning. We've just seen the FTSE 100 jump 4%. The DAX in Germany is up 6%. The Nikkei 225 index in Japan has just finished trading. That was up 9%. Last night, Wall Street reacted extremely positively to the news of pausing the tariffs. The Nasdaq was up 12%. But the big unknown is for how long this recovery will last, because as we're recording this, looking at the future prices, it gives some indication about how US markets might open later on today. And actually, they're showing a bit of a pullback. So it's all, it is slightly confusing. And I think hopefully once you listen to this full episode, you'll get a full sense of exactly what's going on and some things to think about. So Laith and I will go through all the important information. And really, if you've got money invest in the markets, whether that's through an ISA or investment account or even in your pension, hopefully we will address some of the concerns that you might have. So over to the start of the episode, which we've already put together. So I hope you enjoy it. Thank you. Hi, I'm Dan Coatsworth. Welcome to the latest episode of the AJ Bell Money Markets podcast. Joining me this week is Laith Khalaf. Hi there, Laith.
Hello, everyone.
It's been a pretty eventful week, and we're going to unpack everything that's gone on with global market sell-off, why it's important that you don't panic, and what might happen next.
Yeah, quite ambitious to unpack everything, but we're definitely going to give it a go, Dan. Michael Field from Morningstar is here as well to talk about the impact of Liberation Day on European stocks.
And we've also got Jonathan Maxwell from SDCL Energy Efficiency Income Trust to talk about the impact of Trump on all things green. But first up, let's talk about the topic that's clearly dominated the news for the past week, which is tariffs and the wobble in global stock markets.
Tariffs, yeah, let's start from the top, shall we, Dan? Why did stock markets fall?
Well, if you go back last Wednesday night, Donald Trump came out with his big presentation on Liberation Day, imposed sweeping tariffs on all the countries that do business with America, i.e. they supply goods and they sell them into America. So Donald Trump is sort of saying that America's been treated very unfairly. He wants to increase tax revenue from products that American companies are importing. And he wants to use that money to help invest in the country. So, we knew that tariffs were coming. He was being pretty clear from the start. But what we didn't know leading up to that event was the scale of the tariffs. There was a suggestion that it might be 10, 20% universal tariffs, which I guess it would make things easier to understand, but they're not welcome at all by anyone. What happened was we had this sort of tiered system ranging from 10 up to 50% tariffs. Now, clearly, this is really problematic for, particularly for the people at the upper end, in parts of Asia, they're facing very, very high tariffs. And so, investors started to worry. They say, if you've got tariffs, it will make goods more expensive, potentially see businesses buy less, consumers get worried a bit more about increased cost of living. They may spend less money. This all sort of leads to potential hit to the global economy, and of course, this is that's complicated on its own. Let alone the fact that the US is essentially wants to end globalization and completely unravel what's it's been in terms of sort of global trading channels that we've had in place now for quite a long time. So it's understandable that investors got worried, and we saw 3 days in a row of very big stock market falls.
Yeah, it's quite interesting, Dan. I don't know if you saw the way that they calculated tariffs didn't make a huge amount of economic sense, but some clever sparks online had gone and asked for AI chatbots had to impose US tariffs, and all 4 of them came back with the exact way that that they actually calculated these tariffs. So, I'm not saying that's the way that they did it, but would it be hugely surprising if it was? I think we're probably all thinking the same thing on that front. So in terms of the market reaction, obviously quite fierce. What exactly was the scale of the damage?
I mean, if you look at the sort of so we had 3 days in a row, which pretty added up to around about 11-12% declines in places like the US stock market and the UK stock market. Now, on the 4th day, markets went up, and on the 5th day, which is the one we're recording on now, they come back again. So we've looked at the FTSE All World Index as kind of like the proxy for the global stock market, and we've calculated that from the point at which Donald Trump gave his presentation on 2nd of April to the point at which we're recording now, the 9th of April, global stock markets have fallen by $9 trillion, which is a very, very large number.
Fair whack, isn't it?
Yeah.
It's more than you have down the back of the sofa. Yeah.
So, I mean, when you look at it like that, that sounds extremely alarming. If you take a step back and say, actually, look, markets are down 12%. It doesn't seem as much, because if you look back in history, markets do go up and down. You can just get a bit of paper, and you can easily start to build a list of big events where markets have fallen. So, clearly, by the time you're listening to or you're watching this podcast, who knows where things might have gone. But I think it's important to stress that whilst it feels like the whole stock market fell, there was stuff that only fell a very small amount, and actually there are some stuff which went up in value as well.
Right. Okay. What were those? Who were the big losers, and who were those small group of winners?
Well, the big losers were economically sensitive businesses. So mining companies they were amongst the big fallers. That's understandable. So if we're now talking about these tariffs lead to a global economic slowdown, well, that immediately implies that we'll see a reduction in demand for commodities, so metals, minerals, and oil. So naturally, if the price of these commodities have fallen, and indeed we've seen quite a big fall in the price of oil over the last few days, it suggests that companies that produce these, the mining companies, oil companies, they're going to see their earnings hit, and so naturally, you can understand why a mining share or an oil share have not been doing very well in the last few days. Banks as well, they've not been doing well. This is, again, if you have a weaker economy, businesses might struggle to pay back their loans. They may want to borrow less. They haven't got the confidence to do this. And so they've fallen. And sort of tech stuff as well, because I think this is just a case of, it's what's called a risk-off market. When you get risk off, I mean, tech stuff tends to be among the big fallers. The stuff that's held up quite well are what we call defensive companies. So these are businesses that do provide goods or services that theoretically should still trickle along nicely. It doesn't really matter if the economy is in a good or bad shape. So names like United Utilities, if you think that we all still need water, we all still need power to keep the lights on at home. So investors will sort of immediately go to what they deem to be sort of safe haven stocks. Insurance companies like Admiral have held up well. We're still going to be driving our cars to work. We still need home insurance. And then you've got the grocers or the supermarket companies like Tesco and Sainsbury's. They've done particularly well. We all still need to go to the supermarket, fill our shopping basket with food and drink. The world could be struggling, but we'll still be spending money at these types of places. So now, on the day when stock markets started to recover after that 3-day sell-off, you saw names like the tech stocks were right at the top of the list because that was deemed to be a risk-on day. But as we're recording this, it's another risk off. So I think it's really important to try and understand the dynamics of the market and why they do move in a certain way.
Yeah, and we saw this rumor circulating on Monday, didn't we, about a pause to tariffs, which turned out not to be true. But that triggered, a brief spike in the market, didn't it? Almost a fire break in the selling.
It was, I was just looking at the markets, just thinking, what's trying to get a head around. And you suddenly saw things just race ahead. I mean, there's like, and it was only for literally was about 5-10 minutes or stuff. Then it stopped again. What happened was there was an article or a sort of a flash headline from CNBC saying, speculation that Trump was about to announce a 90-day pause to imposing tariffs. And so markets went, oh, this is fantastic. This is exactly what we want. Let's pile back into the market. And so everything went up. Of course, the White House was very quick to rubbish those rumors and say, no, we're not saying that at all. We're sticking with what we've been saying all along. We're expecting a long list of, they were saying, I think Trump said kings and queens and, heads of state and stuff to come and see me and we'll negotiate and do some deals on these tariffs. But a pause, no, that was never on the card. So I think if you look at the markets for the rest of the day, investors obviously were disappointed that we weren't getting that pause, but there was still a sort of sense of, well, now you sort of put it in, you put it out there.
This is the upside, basically.
If it actually gets confirmed, is this going to be the sort of the mother of all rallies? So it gave a bit of sense of hope. And then of course on Tuesday we had this sort of nice bit more stability, and it was pretty welcome, wasn't it, Laith? After sort of what was 3 extremely hectic trading days.
Yeah, so that was Monday was the rumor and also falling markets, but then Tuesday that market bounced back. So was there any actual fundamental news behind that, or policy news, I guess, is what we're driving at?
You had there was an article in the FTSE that said Japan has got priority status in negotiations with the White House. And so what essentially this meant was investors go, right, clearly the focus is on negotiation. So you have different countries that are being imposed these extra tariffs. They come along, they're going to go to Donald Trump and say, right, what can we do to get these tariffs lowered? I don't think anyone's expecting them to be completely removed. It's a case of lowering them. So, Trump has talked about he wants access to things like strategic minerals. He wants to make it easier for American companies to do business overseas, which means he might ask sort of the other side of the party in negotiations to say, like, why don't you lower the taxes or tariffs that exist for American companies? And then of course he wants them to go and come to America as well. Why don't you build more factories here and you can create more jobs for American people? And so I think that was the focus. And so investors are sort of almost like accepting this is going to be the way forward. Talks going on. Let's have a moment of calm. But I think it's quite normal in a market sell-off to see a moment of pause. It's unfortunate that it only lasted a day. As we're recording this, it fallen a bit further, but just that moment of stability, it was so welcome, and hopefully it would have stopped people worrying too much about what was going on.
And then we're here Wednesday afternoon, Dan. At the time of recording, the market has bounced back. Admittedly, by the end of the trading day, it might have all disappeared again. Such is the nature of markets at the moment. But what's been driving the story back into reverse today?
Well, Donald Trump had threatened any country which essentially escalates the situation by going, well, we don't want to, we really don't like what's going on here. We're going to retaliate. So the retaliation is the key thing that's upset people, and that's China. So China said, right, we're not putting up with this. We're going to retaliate. And so Donald Trump said, well, I'm sorry, if you're going to retaliate, it means I'm going to escalate what I'd already said previously. So China now 104% tariff. And so markets like, oh, crikey, we knew Donald Trump was trying to push things, stand his ground. But I think a lot of people didn't think he would actually go ahead with it. And so now we've got another shock to the system. But we've also had some chat that pharmaceuticals were exempt from the latest tariffs. Well, there's just been some reports from an event where Donald Trump was there saying like, oh no, they're coming. So of course we had healthcare stocks sell off, but there was also some activity on bond markets, which certainly raised a lot of eyebrows. So Laith, you are the bond man. What on earth is going on there?
Okay, new moniker for me, but okay. So yeah, we have seen a sell-off in government bonds as well this week, and I emphasize this week because when Donald Trump initially announced his tariffs, the government bond market actually rallied in the US, with the 10-year government bond yield falling from 4.2% to around 3.9% at the end of the week. And if the yields are falling, that means prices are rising in bond land. People are buying them. And that makes sense because, in times of market turmoil, people look for things that are safe. And government bonds, and particularly US government bonds, are seen as very safe assets, in fact. But those lower yields were not sustained. And this week, we've seen, quite a swift sell-off. So the 10-year yield, again, going from 3.9% at the beginning of this week to where it is now. Again, we're talking Wednesday afternoon. So by the time you listen to this, who knows where it will be. But it's back at 4.4%. So above where it was before we had all this market turmoil. So that's, not something that you would expect. And so there's kind of a catalogue of reasons why this might be happening. And it's actually had a knock-on effect across other bond markets as well in Europe and Japan and here in the UK. So one reason is people might be liquidating things that they can sell. So hedge funds might be doing this to fund margin calls. Investors might be doing this, they might be selling equities, but bear in mind quite a lot of investors have mixed asset funds which invest in equities and bonds, and they may think, I just want to get out. And if that's happening, then the bonds are just kind of collateral damage in that trade. There's also worries about inflation, because obviously a trade war, you've just got tariffs piling up, which means goods are becoming more expensive for buyers, certainly in the US, in China, which is retaliating with trade tariffs, and anywhere else it retaliates with trade tariffs as well. So that's possibly of a concern because inflation is the great nemesis of bonds. So that could explain it as well. The other possible explanation is that, the market is looking at a deteriorating economic situation and thinking, well, actually, governments are going to need to borrow more money now because they're not going to get, economic growth, driving their revenues. And we know this, very keenly felt here in the UK with what Rachel Reeves did recently. So they might be thinking, actually, governments are going to have to borrow more money, and that means more government bond issuance, so more supply of government bonds, which could be pushing down prices. And obviously that raises questions around, heavily indebted countries maybe having to pay a bit more now because their solvency, maybe not in question, but it's slightly more in question than it was previously. And then finally, I think there is this, slightly worrying part of the market, which is the US bond market is heavily owned by overseas investors. One of those overseas investors is China. They hold around $760 billion worth of US government bonds. And I don't think anyone is suggesting that they're going to do anything with that right now, because there are lots of levers that they can pull in this trade war before they get anywhere near doing anything with those bonds, which would be extremely harmful. But I think maybe that's just becoming on the radar of markets. At the very periphery, it's a real tail risk, but maybe that's slightly spooking government bond markets as well. But of course, Dan, all of this really, kind of revolves around this point, about what US policy is ultimately going to be. Because at the moment, it feels like we're a week into this. And, there are lots of competing theories about what Donald Trump's end game is and whether he can get there. What actual tariff deals do you think might be possible here?
Well, I think, as you mentioned earlier about wanting to encourage companies to invest more in actual, manufacturing facilities in America. But I think it's going to be cut the tariffs that foreign countries impose on when they're buying US goods. I think that's the key thing, and just access to strategic stuff. So, but I think on a government basis, obviously that's what they'd be pushing for. On an individual company basis, I think most companies will be fingers crossed that their government stands up for them and can get a really good deal and doesn't sort of simply leave them in a difficult situation. But it's probably worth pointing out that on the subject of trying to encourage companies to invest more money in the States, quite a lot of companies on the UK stock market already have a presence there. Someone like AstraZeneca, you might think it just makes all of its medicines and treatments and drugs in the UK, but it's not the case. It's already, and even before the Liberation Day, AstraZeneca is talking about increasing investment in the States. Names like Melrose has factories there already. And I was reading some interesting comments from a fund manager about a Games Workshop. Now this is a classic example of a British company that sells in various parts of the world, including selling goods in America. So the note is from Evenlow, the asset management firm, and they were sort of saying that Games Workshop gross margins on products are more than 70%. So if you calculate that the UK now has a 10% tariff on goods it sells into America, Games Workshop only needs to raise prices by 3% to protect its profits. That sort of on that level, it suggests that perhaps companies can cope with these tariffs. But I think the important thing here is that not every company will have gross margins that high.
Yeah, that's pretty high, isn't it?
Yeah, definitely. They were also saying about Diageo, so obviously that it makes Guinness and various sort of spirit products. It imports some products from the EU, some from the UK, and various places stuff. It's also sort of saying, actually, look, Diageo's got gross margins of 60%, and they think that it will only, at the current as it stands, it will be a 3% hit to earnings from these new tariffs on the UK and the EU. So, but I reckon if you looked at the behaviour of some of these share prices, you might think, okay, if the UK stock market's fallen 10-12%, then have a look at the companies which have fallen less. You might find it's linked to them having high gross margins, having the capability to do well. And actually, Diageo is one of these. They did it, on a relative basis, it wasn't hurt as much as some of the others. And there was a real surprise on the market there that people thought it was going to be subjected to really, really, really high tariffs, and clearly it's not that case.
Yeah, and I think, as with all of this, there's a lot of uncertainty here about what Trump's going to do, what tariffs he's going to negotiate, what tariffs he's not going to negotiate. I think, Dan, there's also a question about, how powerful is he? We're going to find out, aren't we? how powerful a position he's in, because I suspect there are lots of people in America now, lots of wealthy people who are really feeling some pain. And also, if these tariffs start going being levied on goods going into America, which they now are, US consumers are going to feel the pain as well. It's going to be very difficult to explain that away in the short term. So actually, Donald Trump himself might come under pressure, I think. And there was also, a potentially high-profile casualty of the tariff wars, Dana. Don't know if you saw this, but Percy Pigs.
Yes.
Marks and Spencer's has only just started selling Percy Pigs in American. Americans have been deprived of Percy Pigs all this time, and they've just gone in. And Archie Norman, the chairman, said, "Well, they might have to think again about whether they're going to sell them in the US." But clearly a lot of uncertainty swirling around the market. It's probably a good point in the podcast to bring in our first guest. So before Donald Trump unleashed all these tariffs, there was already a clear trend that was playing out in the market where US stocks were out of favor and Europe was in favor. So to find out what the Liberation Day announcement means for that trend and the outlook for Europe as well, Dan caught up with Morningstar's chief European markets strategist Michael Field earlier this week. Let's hear what he had to say.
Well, I'm pleased to be joined by Michael Field, who's Morningstar's chief equity strategist. So, Michael, thanks ever so much for coming on to the podcast.
Thanks for having me, Dan.
Let's talk about Europe. So, brilliant time in the first quarter this year. And then we had Liberation Day, and it seems to have changed the narrative completely. What has it really changed everything for European shares in terms of the outlook, or are there still reasons to be optimistic?
So potentially it's kind of been a game changer. We had been producing our quarterly market outlook that had to be thrown in the bin and rewritten over the last few days, which is a shame, but also gives us some really interesting things to talk about. And like you said, markets in Europe had performed. The narrative, if you had asked me this time last week what's happening, is that Europe had been outperforming the US and other regions, which was great to see finally. But we were saying, look, markets as a whole are fairly valued and there's a few sectors that are looking interesting. But that whole picture's changed now that markets themselves, we see after today's move, probably 8-10% upside to Europe, which is a decent return. And indeed, we see opportunities across a wealth of sectors. So there's not a single sector in Europe at the moment that's trading above where we think it should be, above its fair value estimate, which is a pretty interesting situation to find yourself in as an investor. As to the question of, is this going to impact forever? The weird thing about this current situation that we find ourselves in is that unlike COVID, which I was asked about earlier, the similarities is that this is a completely man-made situation, that technically the situation could be completely turned around and we could be totally in the clear if the US ripped up these kind of tariff mandates that they have. But at the same side, things could get a lot worse. So that's the kind of balance investors have in their mind when they're trying to figure out should they invest at the moment.
I mean, defense and banking, both very popular sectors in the first quarter. I imagine there'll be lots of people who, particularly on the defense sector, will have, actually got quite excited about the outlook. Just because we've got tariffs now, does that really dampen the outlook for that sector in particular? Or actually, is it all, as it stood, 2-3 weeks ago?
So I think, the end of last week, markets fell and people were a bit concerned. But what you saw at the end of last week was shares that are obviously impacted by tariffs taking a hit. You had the likes of Pandora and Logitech, companies that source from Southeast Asia, taking huge hits because Southeast Asia had one of the biggest kind of tariffs going into the US. And then slowly the effects worked their way down, that the market was saying, okay, who else is affected? What consumer stocks, spirit companies like Diageo, should we discount their shares as well? And the answer was yes to that question. So that's what happened last week. And then this week, absolutely everything seems to be getting hit. So it's those second order effects where the market is thinking, okay, look, if there's a general recession, what's going to be hit? And the answer is almost everything. And you spoke about defense stocks, and those stocks are even being hit hard today. You've got Rheinmetall down 16% earlier when I looked at the number, which, considering the run that's had over the last 6 months or so, is amazing. And to your point, has anything fundamentally changed with that stock? No. And if anything, our kind of bad relations that we've got with the US at the moment is going to force us even to spending more into defense. So if anything, that should kind of boost the outlook for that stock. But the market doesn't seem to care at the moment. It's just discounting these things kind of left, right, and center, if you will.
Yeah, because the tail end of last week, when the market started to fall, I noticed like defensive sectors, things that should do well no matter what's going on in the economy, like utilities and tobacco, they were all doing quite well, certainly relatively well compared to the rest of the market. But, as we're now recording this on the Monday, even they are falling as well. I presume it's the same situation as defense stocks. It's just a case of investors are looking at the portfolio and what's done well recently, and they're looking to just potentially take some profit wherever possible.
I think that's definitely one case and one cause. I think the other is that maybe towards the tail end of last week, investors had in their minds, okay, we can move money from, more aggressive sectors which are more exposed to the economy, and move them to these defensive sectors, as you mentioned, and we can hide there. Whereas the narrative this week seems as though investors are thinking, I can't hide in equities at all. And if anything, I may have to take money out of equities entirely. So the picture is kind of worsened in investors' minds, and that's then being reflected in the valuations of the sectors that you mentioned.
I mean, so where does that leave us now then in terms of, is there any part of the market that looks, really interesting to you now following this sort of big sell-off?
So I think what you really have to have in mind when you ask yourself that question is, what's the end game and what is the picture going to look like in a month? So are we going to be at a point where we come to some sort of deal on tariffs, which is a highly likely possibility, or is, the policies being enacted by the US government currently, are they going to change the face of global trade entirely? And are they going to drive many economies into a recession? And those two outcomes are very different in terms of how you make your decision on where to invest in equities.
And so, I mean, as we're recording this, we haven't had any sort of firm deals, certainly not from the EU at all. They sort of threatened retaliation. It seems like a more of aggressive approach versus the UK, who seem quite open about, let's see what we can do and have some sort of proper rational discussions. Do you think the EU is going to be quite aggressive in terms of fighting back, not going to be a pushover at all?
So I think with the UK, they got off lucky to some degree. Trump imposed 10% tariffs on the UK, and the initial kind of roll of the dice was 20% tariffs with the EU. So of course it's in the UK's interest maybe just to take that on the chin and kind of work with it and maybe kind of negotiate down the numbers to maybe high single, mid-single digits, something like that. With the EU, look, it has more power as a larger trading bloc, and it has a few other levers to pull with the US as well. So you can see why they're going to be a bit more aggressive in terms of their response. And I think what's interesting is the fact that China has already retaliated. So I think the fact that a big nation like China has already pushed back on the US, that opens the door a bit more for the EU, that they're not the first nation to push back, and therefore that, they're less likely to be hit as hard as they would have had they put their hand up first.
I think we must be in this situation where people have put a lot of money into the US market in recent years. It's been one of the strongest performers. Now, so I'm getting lots of questions about where can I invest that doesn't involve the US? I mean, is there any sort of obvious places where tariffs won't have a really big sort of impact or change to sort of earnings potential for certain companies?
So I think not really is the answer, unfortunately, that this is really turning into somewhat of a global trade war, especially as nations like China retaliate, that there's so many unknowns at the moment. One of the theories thrown out in the beginning of all this was, look, will this make, bonds forge closer between the EU and UK and China? Are we going to maybe pick up the slack and buy more from these countries as a result? But with so many kind of variables in the mix at the moment, I think that's getting more difficult. And indeed, trying to figure out, like you said, where you can invest that's that's going to be less impacted is far more difficult. There are some obvious candidates, right? Sectors you mentioned earlier, utilities, for instance, that are more national or kind of international, but perhaps more Europe focused are obviously one angle. And those stocks saw valuations kind of rise or stay steady at least last week, but they're seeing outflows at the moment too. So it's not like you can hide from that entirely. The other area perhaps is kind of further down the list in the UK, for instance, for your listeners, something like FTSE 350 stocks further down that are more UK exposed, for instance, have more of a national base. Companies like this might be more insulated to some degree, but the likelihood of companies getting off scot-free entirely, if indeed this global kind of trade war lasts, is very low, unfortunately.
Well, Michael Field from Morningstar, thank you very much for coming on the podcast.
Thank you.
Thank you very much to Michael for talking to us on the podcast. Now, Dan, so many things are moving around at the moment. I suspect many people are, alarmed by wild swings in the market. I've definitely had, messages from people who know what job I work in, asking me what they should do. Actually, mainly should they sell? So, what would you say to someone who is worried at the moment?
Well, I think if you have been watching the news, if you've looked at your investment account over the last week, I think it's understandable that you might be worried about your investments. And also, I think it's really important to stress here that a lot of people in this country might not realize that they are invested in the stock market because through their pension, particularly if you've got a workplace pension, you might be investing in, making contributions every month out of your pay packet, but not really realizing where that money went. But it is in, almost certainly will be in stocks and shares. And so this is why the tariff stuff really matters. But I have to really stress here, you mustn't worry about what's happening on the markets. History suggests that markets go through difficult patches on a fairly regular basis. If you take a sort of a 5-year chunk, you almost certainly will see a difficult period there. Now, if you go back, cast your mind back to COVID 5 years ago, we had a sort of a nasty patch there. Global financial crisis in 2008, 2009. And there's been plenty of times before, but really importantly is, these stock markets, they go through a troubled period, but they tend to bounce back quite quickly. No one knows when markets will truly recover from the current wobble. But if you have time on your side, really the most important thing here is just stay focused, keep yourself invested in the market, because investing is all about having a long-term perspective on things. When markets are down, you've actually got an opportunity potentially to consider buying stuff that's a lot cheaper than it was a week ago. And it's this principle that if you're looking about long term, you're making regular contributions into your pension or into your ISA, or another form of investment account. Hopefully, you buy low, you buy high. These things average out. So when things are good, I think lots of people have the confidence to I want to keep investing in the stock market. When things are looking a little bit more gloomy, like they are at the moment, you should still look at this as an opportunity to say, well, there's lots of really good things on the market that I like. I should really keep going at it. So I think staying focused. Now, if you're already in retirement, you might think, I'm in a different situation here. Perhaps I haven't got as long a term horizon to ride out the ups and downs of the market. Well, I think the key thing to think about is if you're in retirement, you perhaps have already changed the structure of your portfolio. You might have more things like bonds in there, so lower risk assets to potentially help give a bit more of a cushion to it. If you're generating an income from your investments to help pay the bills, at the moment there's no sign of any of the changes to dividends that these companies will be paying. So this stream of income hopefully should stay fairly consistent to what it's been recently for a while. And clearly, if we do get a recession, companies might look at dividends down the line and reassess what they're paying out. But for now, I think it should be business as normal. But if you find that actually, the dividends that are generated from your investments aren't enough anyway for you to live off, and you actually are selling little bits of your holdings, just have a look to see how much money you're really taking out of your pension. I think a lot of people might find that they take out a bit more than they really need. So when markets are down, it might be a time for you to say, well, I could probably cut back on a few little luxuries. I think you might thank yourself for it in the long term, because taking money out when markets are down means that if you keep going at the same rate as before, you might deplete your pot faster than previously you might have expected. So if you obviously everyone's in different situations, but keep your cool, and perhaps you might want to think, well, if I've got spare cash, maybe I'll draw upon cash savings first and leave my investments as they are, give them a bit more time to recover. Laith, is there anything else you think you could, words of wisdom you want to add on to that?
Well, I mean, I think you've encapsulated it well there, Dan. I think the one thing that you've mentioned there that I would also echo is the idea of regular savings, putting money into the market regularly, because you smooth your journey. You buy in at high points, you buy in at low points, and maybe that's monthly, maybe it's annually, but you're still buying in over maybe the course of 20 to 30 years at different points in the market. And the thing that I often come back to is, if you were happy with your investment strategy 2 weeks ago, then markets have moved, but you should still be happy with your investment strategy, because that should be a long-term thing that you've decided on in terms of how much risk you want to take. And as you say, Dan, if you're kind of in retirement, then maybe you've dialed down risk already. So it's definitely not a time to panic, because history tells us that often the best times in the market follow the worst times in the market, and we've seen a big sell-off now. What's that saying? It's, the stock market is the only marketplace in the world where buyers stay away when there's a sale on. I think at the moment, selling out after such a big fall does feel like it's hitting an emotional panic button rather than actually sticking to your long-term investing strategy. But that's where we are in markets, Dan. Would you like to talk about something else that's not about tariffs for a moment, for a brief moment? We have some respite from tariffs for a moment. So, it's the beginning of a new tax year. So we've done some numbers on investing, either at the beginning or the end of the tax year. So, as you know, Dan, most people fill their ISAs at the end of the tax year because there's a deadline. And so these last 2 weeks, are hugely busy with people topping up their ISAs to get in before the 5th of April allowance it renews. But there is a group of people who pounce as soon as the new tax year is open. On the 6th of April, early bird ISA investors put their money to work in the market. And we've just run some numbers to see which strategy is better: wait until the end and being a last minute ISA investor, or doing it at the beginning, being an early bird ISA investor. And we've run the numbers, assuming that you stick to that strategy, whatever strategy you choose, you stick to it since 1999 when ISAs were introduced, and then you invest every year on the same date. And actually, if you were an early bird ISA investor, investing £5,000 a year, then you would be over £19,000 better off than the last minute ISA investor investing exactly the same amount, because you're putting both putting £5,000 in every tax year. It's just that the early bird is putting it in that bit earlier. Now, that's not always going to be a winning strategy. There are times when actually the stock market is going to fall over the course of a tax year. The last tax year is a good case in point. The market was actually doing very well until these Trump tariffs. But actually, if you look from the start of last tax year to the end of the tax year that's just gone, your typical global fund actually fell 5%. So in that particular year, it would have been better to be a last minute ISA investor, because you're buying at a little bit of a lower price. But obviously, you don't know that at the beginning of the tax year that the market's going to fall. You don't know whether it's going to rise or fall. But actually, history tells us that it rises more often than it falls. So your typical return on average across a tax year is 7.7%, and the market rises in 17 out of 26 tax years. So that if you're investing consistently as an early bird or the last minute ISA investor, your early bird is getting the much better part of the deal. As I say, on a £5,000 annual investment, you're over £19,000 better off over the last 26 years. And it's quite interesting, Dan. We actually took a look at how many early birds there are in kind of AJ Bell's customer base, and actually found there's quite a surprising number of early birds. Out of the number, all of the people who maxed out their ISA last tax year, so 2023, 24, actually that's not last tax year, is it? Because we've just gone past the tax year. It's the tax year before. But 2023, 24, 20% of customers who maxed out their ISA did so in April. So I was quite surprised. I thought that's actually quite a big chunk of people. And obviously, many people just want to get their money to work in the market as soon as possible. And also, there's a tax advantage. If you're holding maybe shares outside of an ISA that are paying dividends, for instance, and you leave it till the end of the tax year to kind of move them into an ISA, then you're potentially liable to dividend tax, income tax on your dividends throughout that year. Whereas if you put them into an ISA, you would save on that tax as well. So, I think it's kind of an interesting one to look at this time of year. And lots of good reasons if you have the money to be an early bird ISA investor. Don't know about you, Dan. I'm a bit all over the place. I do try to get a little bit of money in the market at the beginning of a tax year if I've got any kicking around. But then I'll also do a bit of a clean-up job at the end of the tax year as well.
Yeah, I'm bit boring, to be honest. I'm a set amount every month. Every month. Yeah. So
sensible. That's really sensible.
Yeah. I would say we were, it's an interesting thing, but I mean, it's not, I always think it's quite interesting to see, how different investors approach putting money into the markets. I mean, it's everyone has different ideas about what might go into their portfolio, but it's how much they can afford to do, how frequently they do it. And actually, we had a quick look for this podcast to see what have AJ Bell customers been doing over the last week, given the turmoil in the market. So I think you might expect them to have been sort of obviously troubled by what's going on in the headlines, but the data that we've seen would suggest otherwise, because actually we saw significantly higher than usual trading activity in sort of particularly in the first few days of what was going on with the sell-off. Obviously some customers might have been selling down some positions, holding some cash to wait and see, but actually it was the number of buy trades were more than double the number of sell trades. So a bigger proportion of customers here are seeing this sort of market wobble. It's a buying opportunity. So it goes back to what you were saying, Laith, that sometimes some of the best interesting opportunities are when everything is all looking a bit gloomy. I guess you are able to buy at that lower level. So I think it is really interesting. Obviously, there might be some people who are doing, as you're saying, they're the early bird investors, using the new tax year to invest. But overall, it does look like people are sort of hunting for bargains. They might have had the sort of a list that had been kept for ages, saying, "I've always wanted to buy that company, but always looked too expensive." Well, now it's on sale.
Yeah, absolutely. And we know that. A lot of people obviously are sitting on a lot of cash at the moment. We've seen big flows into cash ISAs. So I guess there's maybe a question about whether now the market has fallen, maybe people at some point, when perhaps they get a bit of confidence, or already if they're quite adventurous based on the statistics you've just disclosed there, Dan, if actually they might start using some of that to buy the market too.
Yeah. So obviously, while we're on the subject of what investors have been doing in their portfolio, so Laith, I know that you've been looking at some data with active funds. As I presume this is pre-Liberation Day chaos data. So.
Yeah, it is. It's from the Investment Association. which is the industry body for the fund management industry. And they put out kind of monthly data on fund flows. And the latest one they put out is for February. And it's showing a continued withdrawal from active funds. This is something that we've seen for the last 3 years, very big withdrawals from active funds. And it looks to have continued apace this year. So February, £2.4 billion withdrawn from active funds. That is taking the total for the first 2 months of this year to £7.1 billion withdrawn from active funds. And I guess the question is, what is happening to that money? Around half of it is going into passive funds. So they're still doing pretty well. People, for various reasons, obviously like passive funds at the moment, performance probably being one of them. But around half the money coming out of active funds is going into passive funds. Around half of it has actually just left the funds industry altogether. So that could be people perhaps moving to cash, perhaps paying down their mortgage now that interest rates are higher. Might be people moving into investing stocks, individual stocks perhaps, which aren't covered by this data, or maybe ETFs, which are only partially covered by the data. So I think, active funds are really, really struggling to attract money at the moment. And, that's particularly the case in the UK. Also, big outflows we saw from the UK equity fund sector as well, £1.4 billion coming out in February. That takes the total for January and February to £3.1 billion withdrawn from UK equities. Again, that's been an even more long-running story. That goes back to 2016 that we've seen these very large outflows from UK equity funds. And I guess that particularly that UK story kind of sharpens focus on what the government can do, in order to get people investing in the UK. And, I think there were some rumours about maybe scaling back the cash ISA allowance. Will that happen? We still don't know. But one idea is that maybe they stop discouraging investing in the UK by imposing stamp duty on UK share purchases. So if I go and buy Apple shares, they're US listed, I can do that without paying stamp duty. But if I want to buy AstraZeneca, they're UK listed, they have to pay 0.5%. That doesn't make a huge amount of sense if you're a government who is trying to incentivize investment in its own stock market. And clearly times are tough. We know Rachel Reeves hasn't got a huge amount of money to play with, but it strikes me that that's a lever that she could pull. I actually wonder, Dan, if given the market turmoil, it's a brave call, but it might be the time to do it, because I think a lot of money is going to be looking for a home. And if a politician like Rachel Reeves was to send a signal like that, I think it could be very powerful. Obviously, I don't have to balance the books, but I just think that it could be, something that shows that Britain and the UK stock market is open for business. But another kind of slightly lesser idea that AJ Bell has put forward is that perhaps it might be too costly to get rid of stamp duty altogether. But what about doing it just on people investing in their ISA? So that would be, a much lower amount. We reckon somewhere in the region of £120 million that would cost the Treasury. Again, might be a powerful signal for investors that could just act as a catalyst, because at the moment money is flowing out of the UK equity market, and it's also flowing out of active funds. And again, there's a question, what about this market turmoil? How's that going to affect active funds? I think arguably, don't have any data for this, but my feeling is that probably active funds have probably outperformed passive funds in this market fall, because they wouldn't been so heavily exposed to some of the areas that have fallen the hardest. But equally, they're going to have fallen. And that might actually mean they're still seeing outflows, and passive funds might see outflows as well over this period. We'll have to wait and see. But yeah, continued problems for the active fund market, I'm afraid.
Yeah. Well, we've got time for one more guest on the podcast this week. And I'd like to say that we planned this specifically, but it is pure luck. We've managed to book a guest who essentially works for one of the stocks that actually stood its ground and avoided the big sell-off that we've seen in the last few days. So it It's an interesting one. I think it was pure coincidence, pure luck that we booked this one.
That's right. We're going to be talking about SDCL Energy Efficiency Income Trust. To learn about the opportunities and challenges ahead, Dan recently caught up with Jonathan Maxwell. He's the boss of the investment firm which manages the portfolio. So let's hear what he had to say.
So I'm pleased to be joined by Jonathan Maxwell from the SDCL Energy Efficiency Income Trust, also known as See It. So Jonathan, good to see you. Could we just start the conversation perhaps by explaining what exactly is your investment trust and perhaps how does it differ to other ones in the green renewable energy space?
Sure. So See It, which is called the SDCL Energy Efficiency Income Trust, invests in energy efficiency projects. So whereas most investment companies, certainly that are listed on the London Stock Exchange, focus on generating energy, that is mostly power, for the grid, typically. See It, the Energy Efficiency Income Trust, actually focuses on investing in energy services that A, are efficient, and B, that are delivered directly to customers. So the primary business model is to provide efficient and even decentralized, that is direct to customer energy solutions. So it's an infrastructure investment company. It builds infrastructure, but instead of building centralized energy infrastructure that plugs into the grid, it builds decentralized energy infrastructure that service pretty much on-site end users. So our customers are long-term heavy end users of energy. Our infrastructure investments are the projects that deliver energy services to them, like power, heat, cooling, even light. And our income under the contracts is to provide those services. And that's the basis of the infrastructure investment policy.
I think lots of companies in this current environment they're looking at ways to save money, to run more efficient operations. But I think that, on a broader scale, it's almost like if anyone talks about anything sort of green related, there's a different sort of tone. We've had Donald Trump come back into the White House. It seems to be rolling back green policies. Energy companies like BP saying, actually, we're gonna stick with fossil fuels, oil and gas. We're not going to do as much in sort of the renewables. So does those sort of broader things going on in the world, does that make your job harder in terms of finding investment opportunities?
Well, our purpose is about making the world more efficient, about making our customers, meaning buildings, industry, and transport, more efficient. So efficiency has a few fantastically important characteristics or outcomes, right? One of which is you cut costs. The reason you can cut costs is that if you can be more efficient in delivering energy services, you use less energy to do the same or more. So cutting costs and therefore improving productivity, that's a pretty good thing, frankly, whichever side of the political aisle you sit on either side of the Atlantic or anywhere. So that's the first point. There's a commercial sustainability underpinning it, cutting costs and improving productivity. The second key feature of building energy like we do right on site for end users rather than plugged into the grid in the middle of nowhere is if the grid fails, like it did at Heathrow Airport last week, the on-site generation systems that we build and operate provide a level of security and resilience. So that's the second. It's not just that they're cost efficient and most often more cost efficient than the grid, frankly, but they're also resilient and very often more resilient than the grid because you've got the energy on site rather than relying on it being plugged in. And then the third element is carbon. Now it goes hand in hand with economic and security benefits, right? If you're using less energy to do the same or more work, which is more economically constructive or sustainable, if you like, if the energy service is delivering fundamental resilience or energy security, at the same time, using less energy uses less carbon. So you're delivering environmental outcomes at the same time, hand in hand with economic, and security resilience objectives. And that is, again, cross-cutting. Now, the income streams that we invest in are typically contracted revenues with end customers to deliver them services that are lower cost, lower carbon, and more reliable than the grid. So when government policy changes, it can have a huge impact on the way that certain markets like renewable energy work. It can certainly play around with market incentives, subsidies. But the focus of our investments is and has always been to the greatest extent we can, focusing on projects that have basic root commercial sustainability. That is, that they can deliver lower cost, lower carbon, more reliable than the grid. That's what makes it competitive and sustainable.
How is this sort of negativity around sort of broader green things at the moment affecting sort of asset valuations in this space? I mean, I know some of the stuff you do is actually, you know, doing a service, right? I'm saying that you installed like LED, energy efficient lighting stuff, but you also you actually also invest in projects as well, don't you? So
yeah, we invest in, by projects, you mean projects that supply energy as well as save energy. We do. I mean, we invest in pretty much all forms of on-site energy generation. What do I mean by that? The dirtiest secret of the energy sector, I'll let you in on, which is that most energy is wasted in the energy system. Let me break it down. 10% of the world's energy gets wasted as you extract and convert oil, gas, and coal, which is roughly 80% of the world's energy. About half of it is lost with the word I'll leave you with today called entropy. It's effectively waste heat. So when you put gas into a turbine, half of it turns into electricity, half into heat, just disappears into space. And then another 10% gets lost transmitting and distributing it. So then in your building, did you know that 2/3 of the primary energy, that is the original fuel that went to make the energy in your building, has been lost before it gets to your front door?
oh wow, okay.
Yeah, so that's the extraordinary dirty secret of the energy sector. So what we do within SEER and more broadly across the entire SDCL business to make the world more efficient is to build energy generation systems on site. And you can do it cost effectively using on-site solar, ground and air source heat pumps, even, frankly, natural gas, as long as you use it efficiently, capturing the heat rather than wasting it like centralized plant, and using the heat for cooling rather than dumping it, or heat for heat. So on and so on. So SEER, the company, owns a vast array of projects that are all solving this problem. They're by doing one thing, building energy services where you need them, rather than in the middle of the countryside. By doing that, it's lower cost, lower carbon, more reliable than the grid. So a lot of what we do is supply energy, meaning power and heat. And a lot of what we do is save energy so that even when your building gets the energy from the grid, and maybe 2/3 of it has been lost, but 1/3 of it survived. Wouldn't it be terrible if your building then went on to lose another 1/3 of the energy that it used because, let's say, it didn't have the right lighting, heating, ventilation, air conditioning? So we invest in solutions to that problem. We replace the infrastructure, we make the upfront payment, that's our investment, and our return is a contracted service. We'll provide light as a service, heat as a service, and so on.
So I presume when you're talking to prospective clients, it was the conversation, we can help you achieve your sort of perhaps net zero or, you know, environmental goals. Is the conversation now all about, we can save you money, but, you know, as a plus, it's also about green, but it's all here about saving money?
It's three things, and it's and. It's not or. It's got to be cost efficient. We want to make a cost efficient, frankly, cost reduction project for you by allowing your business, your government, your transport asset to do the same work, just using less energy, right? So that's the first point. We want it to be cost effective for you. Second, and by doing that, we're going to make you more environmentally carbon friendly, because you're not going to be wasting the energy that you're wasting today. And that's going to be much more carbon efficient for you. And by building the energy system and the energy service at your site, we are going to reduce your reliance on the grid. We're going to make you more secure and resilient. So it's and. Those are the three drivers. It's symbiotic. It's not either you're going to be carbon efficient or you're going to be commercially sustainable or commercially successful. It's, we're going to make you commercially sustainable and resilient, and we're going to reduce your carbon footprint, or we're going to create the environmental outcome for you by doing something that's good for you from a cost and from a resilience perspective.
Okay, so I mean, perhaps could you give me an example of, you know, if I was looking to put money into your investment trust, what sort of projects do you currently have, you know, that was generating the income for you?
So we've got, I would say, a variety of different types of projects, but they all fall into one of two categories. They either generate energy for customers on site, lower cost carbon, more reliable than the grid, or they help buildings and industry and transport save energy. I'll give you an example from each one. So, for example, on-site generation, See It owns a platform for development and construction and long-term ownership and operation of solar panels on commercial buildings across America. So for many years, we've been developing the platform. It goes out and it finds customers like warehouses, logistics, municipalities, universities, schools, hospitals. It designs solar with storage solutions for those customers. It's capital efficient, so it works in a sophisticated manner with the capital markets in America. So it can be best at designing and rolling out solar and best at providing capital efficient solutions. The two together mean it can provide the lowest cost, highest performance solar solution for its customers in America. It's one of the highest quality, if not the highest quality platform. The benefit for the customers is lower cost, lower carbon, more reliable than the grid. The benefit for you as a shareholder of See It, if you were, would be that you would be earning income from the company based on long-term contracts with really high quality credit counterparties. So that's kind of an example of on-site generation, an example of energy conservation, probably the classic one actually that See It launched with, and it's done very well with. In fact, the project has now worked all the way through its life cycle from construction through operations and even to exit now. It was a project we delivered for Santander Bank in the UK last decade, about 10 years ago. We together with a technology partner, we designed and installed LED light bulb solution, LED lamp solution, I should say, across the entire estate for Santander Bank in the UK. So 814 buildings, 90,000 lamps. We designed a project to change all of the light bulbs to LED, and while we were at it, change the heating, ventilation, air conditioning, and building management systems. The project cost us just less than £20 million, but we paid for the project. And then we charged Santander a fee that was less than the cost saving that they generated over the time. So the project was in the money, both for them and for us. It was a great win-win, economically advantageous for us, economically advantageous for Santander. They saved money. There was no cost or risk to them on the installation of the project. It dramatically reduced their carbon footprint, and it improved the resilience of their building infrastructure because they didn't have to change as many light bulbs over the period because we did it through our contractors for them. So that's a great example. On the supply side of the advantage of delivering energy on site that's lower cost, lower carbon, more reliable than the grid. On the demand side, an opportunity to help buildings stop wasting so much energy and to use those savings even to finance the better infrastructure that is more resilient.
Well, Jonathan Maxwell from SDCL Energy Efficiency Income Trust, thank you very much for joining us today.
Thank you.
That's all we have time for on this episode. Thank you for listening. The Money and Markets podcast will be back with a deep dive next week into the pension freedom, so be sure to check that out. We'll catch you then. Bye for now.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.